HIMS and her stock is down huge. The bears are out. Is this the end of HIMS stock? Also, I have a fantastic article later on this video. And also, I made a move on my Patreon portfolio. Can you guess what it is? So yeah, let's start off with the bear case. But before we get to that, Shamao says to like and subscribe. So yeah, the bear case for HIMS stock, what do we have? The bear case for HIMS, in my opinion, is as follows. 1. They are in a commoditized business filled with intense competitors. Row, and they mention a couple of others. By the way, before we get to that, HIMS stock is trading at $14.41 per share, down 2.17% on the day. What can I say? It's September, but they are down significantly from their all-time high of $25 per share. Significant. They've erased all their GLP-1 gains from that announcement. They announced GLP-1 skyrocketed to $25 per share. The short report comes out, the bears come out, and now it's tanked to $14.41 per share. Is this warranted? Let's discuss that in today's video. So anyway, let's get into that the bear report, or the arguments rather, and they mentioned Row specifically. Let's look at the BBB on Row. And first off, Row is a much smaller competitor compared to HIMS. Just 44 reviews at the BBB. Average customer review, 1.2 out of 5. Here's one reviewer. Row would not tell you what the pricing was until you signed up for the monthly subscription. See, the thing is, Row charges you a $99 consulting fee that you cannot refund. You can't refund it. You'd probably have to do a chargeback to get that money back, and even then, they're going to fight it. So yeah, you pay the $99, and then they may tell you at the end, we can't help you, and you're still out the $99 consulting fee. It's sketchy. It's sketchy. Just for you to find out, the pricing is higher than what you can get online, quicker and cheaper. You're paying the subscription up and above this cost. It's a scam. They will not return your subscription fee, even when they do not provide a service. Once I found out the price, since they won't tell you until you pay them, I canceled. No service provided, and it's a scam to require a subscription to find pricing. Beware, so you don't pay money to find out that they are overpriced, and that's on Row, not HIMS. Now, what's HIMS rating on the BBB? 3.85 out of 5. Note also that the number of customer reviews is actually much higher, 4,575, whereas with Row it was 44. So Row is a much smaller company compared to HIMS, and they're a little more sketchier. I don't know if I would trust them. HIMS is the one you want to trust, and HIMS has, the moat in this space. They're the big dog in this space, in this specialized telehealth space in this area. Okay, so what do we have else? Or what else do we have? I speak like Yoda sometimes. They have a high marketing spend, 50% of revenue, which raises red flags regarding customer retention. Now, the one thing I will say there is revenue and customer retention have nothing to do with each other. Whether a customer retains HIMS depends on HIMS service, not their revenue. That's number one. But beyond that, what is their marketing spend as a percent of revenue? In 2023, marketing spend was $107 million. In 2024, marketing was $145 million. But revenue grew from about $8 million to $315.6 million year over year. Now, both those numbers jumped big, but the thing is that revenue actually declined as a percent of revenue. See, in 2023, marketing was 51.6% of revenue. In 2024, it's 45.9% of revenue. So the thing is, marketing grew 35% year over year, whereas revenue grew 52% year over year. So the marketing is producing more revenue than the marketing spend. So it's marketing spend well placed. And this is one of the reasons why HIMS is now a profitable company. And look also, subscriber and revenue growth is up 43% year over year compared to the 35% in marketing spend. And as I mentioned, revenue is up 52% year over year. Please note that includes GLP-1s. Now also note the average spend per customer increased to $57 per customer, which is fantastic. That's a monthly online revenue per average subscriber is what that's called. So yeah, let's move on. What else do we have? There's concerns about margin contraction. Most of the profitability growth has come from gross margin growth. If selling COGS increases and they cannot pass these expenses on to the customer, the fundamentals get hurt a bit. All that being said, I am more bullish than bearish on the company as a whole. Just those are the recognizable red flags I am trying to monitor. Okay, so addressing that. Margins declined a little bit in the last quarter, from 82% to 81%, lower from a high of 83%. However, in this space, these are magnificent margins. These are nearly software-like margins. 81% is a significant gross margin. Still, I mean, just look at it. From Q3 of 2022, gross margin, gross profit was $145 million. Last quarter, it was $316 million. That's more than a double over a couple of years. That is an enormous gross profit increase. Even though actually technically margins are increased from 79% over that span, from 79 to 81%. But the thing is also, it's more than just gross margins. What else is it? It's also free cash flow margins. Look at free cash flow. Grew from $10 million last year to $47.6 million this year. So that's a margin of free cash flow of 5% last year to about, 12% last quarter. So that's a doubling of the free cash flow margin. And that is up 377% year over year compared to revenue growth of 52%. So that is a substantially increasing FCF margin. And HIMS is expecting that margin to grow. They're expecting a different margin. They're expecting adjusted EBITDA margin to grow to 20 to 30% long term. So anyway, what other margin do we have is the net income margin. That's growing from a negative $7.2 million to a positive $13.3 million year over year. So you can tell right there that HIMS is becoming profitable and more profitable every quarter. Adjusted EBITDA grew from $10.6 million to $39.3 million, up 270% year over year. That's over 10% adjusted EBITDA margin. And as I mentioned just a minute ago, they're expecting that to nearly double from this amount to 20 to 30% adjusted EBITDA margin in the long term. So margins are improving, not decreasing. Okay, so what else do we have? 2024's outlook is a year-over-year revenue growth of 65 to 68% in Q3. That's next quarter. And for the full year, 57 to 61%. Adjusted EBITDA margin, adjusted EBITDA in dollars, $35 to $40 million next quarter. Full year, $140 to $155 million, growing from 9 to 11% to 10 to 11% adjusted EBITDA margin, as we just discussed. See, the thing about HIMS is a very small company in market cap. So when you get these kinds of numbers, when you get these kinds of free cash flow of $47 million, it may seem small, but when the market cap is, I think it's $3.5 billion today, it's growing, and it's going to be a pretty substantial portion of their overall market cap. So when they do start to buy back shares, they're going to be able to buy back a significant amount of shares because in my opinion, this company is significantly undervalued compared to what they're capable of. See, the thing is, Wall Street hates telehealth stocks. And that's what this is. Let's face it, this is a telehealth stock. But this is for stigmatized medicine. There's, the general telehealth stocks like Teladoc. I do not like Teladoc. Teladoc has terrible numbers, terrible fundamentals. But HIMS, I love. Because HIMS is profitable. HIMS may be smaller, but they are profitable and they are growing fast. Teladoc is not growing and they are not profitable. So what's the new news? We have some fantastic new news regarding HIMS. Novo Nordisk's Ozempic shortage expected to continue into Q4 this year. So this came out just recently. Novo Nordisk said the shortage of lower strengths of its diabetes drug Ozempic has deteriorated. See, there's two main brands that provide GLP-1s. There's Ozempic and there's Wegovy. So the thing is that these are the two name brands, and because these are in shortages, HIMS is able to supply a compounded alternative at a much cheaper price. It's like 85% less expensive on HIMS, and they're still significantly profitable because it's a compounded, personalized medication. So anyway, they're saying that the shortage of lower strengths of its diabetes drug Ozempic has deteriorated. Now that may sound confusing, the way that it's worded, but what that means is that the shortages are actually getting worse because more people need this product. More people want GLP-1s. So the shortage situation is getting worse, which means that the shortage are going to last longer. And the longer they last, the better for HIMS. With intermittent shortages for all strengths expected into the final quarter of 2024 due to increased demand and along with capacity constraints at some of its manufacturing sites. In a note published by the European Medicines Agency on Monday, the obesity drug maker recommended healthcare workers continue limiting treatment initiation of new patients on Ozempic and its other diabetic drug, Victoza, until the supply situation improves. So anyway, yeah, Novo Nordisk is a huge company in Europe. They're one of the biggest companies in Europe now because of GLP-1s. HIMS is one of the smallest companies in America, also with GLP-1s. As I said before, HIMS is trading now as if GLP-1s didn't even exist. They're at the same they're trading at a lower price now than they did before they announced they were selling GLP-1s, a lower price. So the GLP-1 addition to HIMS is 0. It added 0 to the stock price from then to now. Okay, so anyway, what else is going on is that even after the supply shortage ends, Andrew Drudum, who's the CEO of HIMS and Hers Health, says he thinks that they're going to be able to continue selling personalized compounded medications after the supply shortages end. Now, here's his opinion on this matter. And this is a tweet by him. He says an estimated 100 million people in the U.S. are struggling with weight-related challenges and are struggling to access the GLP-1 medications they need, whether because of limited supply, outrageous cost. See, those other ones, they're like $2,700, $2,800 per month without insurance. It is insane. Whether because of limited supply, outrageous cost, or an approach to dosing that isn't tailored for the best individual outcome. Some patients generally will see their best outcomes with branded medications, but there is demonstrated clinical need for personalization through compounding. Compounded versus branded GLP-1s isn't an either or. Now, just to remind you, compounded is what HIMS offers, whereas branded is what Novo Nordisk and the other one offers, Eli Lilly. That's what they offer. We need both options readily available to provide a breadth of solutions for each individual's need. An approach that prioritizes choices as a key element of access means individuals can not only have reliable, consistent access to their medications, they can also find the solution that is best for them. Now, regardless of this, obviously, HIMS is expecting to be able to continue selling their compounded medications after the supply shortages end. But even then, I do expect that the brand name manufacturers to sue them to try to stop this from happening, because this is going to harm their bottom lines. It's going to harm their bottom lines significantly. So I do expect a suit in the future. The results of that, we'll see. And also on HIMS Q2 24 earnings call, Mr. Drudum shared the following logic underpinning his stance that HIMS will continue to offer GLP-1s in a post-shortage world. This is highly controversial, but there's logic to his stance. In essence, his reasoning was that personalized GLP-1 offerings have legal precedent and are acceptable in instances where a patient cannot tolerate the name brand product and its protocol. And you can read it here. This includes Andrew Dudum's actual statement and some additional notes on that. So, will HIMS and Hers Health be able to sell it post-shortages? I don't know. Their CEO is confident, their COO is confident, but whether or not they're able to, I'm pricing it as if they can't. Because I'm pricing it based off a conservative model, which is, I think, their worst case scenario. So I price GLP-1s at a price of 0. I don't account for it in my DCF model. So what happens in a world without GLP-1s for HIMS? In a world without GLP-1s for HIMS, they're still growing 46%. Out of the 52% growth, only 6% was related to GLP-1s. They're still a massive growth company, even excluding GLP-1s. That's what my DCF offers, and I think that even without GLP-1s, they are significantly underpriced. And actually, I think it's due to the GLP-1 issue and possible litigations that I think is driving down the stock price. So, what do I do when I think the company is bound for a beautiful future, but it's currently not priced for that future? Well, I usually buy stock. In this case, I bought 2 leaps. These leaps go out to January 2026. That's the furthest out that was available. In about 2 weeks, HIMS is going to come out with new leaps that go out further than that, and I'll probably roll these into new leaps when that occurs, because I want leaps as far out as possible. That's what I always do with leaps, and they're also small quantities. This is on my Patreon portfolio, and these make up a very small portion of that already small portfolio. So anyway, yeah, these are 2 contracts filled at $5.10. I bought them earlier today, and I bought them at market open. And yeah, that's it for me. Don't forget to like and subscribe. Also, let me know in the comments what you think about HIMS, what you think about GLP-1s, and everything else. Thank you for watching. Now I'll see you in the next one.